just lost $3,000 in one click. Not because the market was rigged, not because you got unlucky, but because your brain did exactly what it was designed to do. And here's the terrifying part. Every single investor, from beginners to billion-dollar fund managers, is fighting the same invisible enemy, their own mind. Today, we are going to walk through the psychological traps that quietly destroy most investors. And I will show you the one mental shift that changes everything. Stick around because the last trap on this list is the one nobody talks about, and it might already be costing you money right now. Here's something your finance teacher never told you. Investing is not really about numbers. It is about behavior. A 2020 study by Dalbar found that the average investor earned nearly half of what the S&P 500 returned over a 20-year period. Same market, half the results. The difference was not intelligence, it was not access to information, it was psychology. Our brains evolved on the African savanna, where fast emotional decisions kept us alive. But those same survival instincts, the ones that told our ancestors to run from danger and chase after food, those instincts will absolutely wreck your portfolio if you let them run unchecked. Let's talk about the first big trap. Loss aversion. Psychologists Daniel Kahneman and Amos Tversky discovered something wild. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So losing $500 feels about as bad as winning $1,000 feels good. Think about that for a second. This is why investors hold on to losing stocks for way too long. Deep down, selling feels like admitting defeat. It makes the loss real. So the brain says, just wait, it will come back. And sometimes it does. But sometimes a $500 loss turns into a $5,000 loss while you were busy hoping. Loss aversion is not weakness, it is just wiring, but you can rewire it. The second trap is called herding, and it is exactly what it sounds like. When everyone around you is buying, your brain screams, get in before it's too late. When everyone is selling, your brain screams, get out before it gets worse. You have seen this play out. GameStop in 2021, crypto in 2017, dot-com stocks in 1999, millions of people piling into the same trade at the same time. Not because they did the research, but because the crowd was moving and sitting still felt dangerous. Warren Buffett's most famous rule is, be fearful when others are greedy, and greedy when others are fearful. That sounds simple. But going against the crowd when everyone is screaming at you, that takes serious mental training. Here comes trap number 3, confirmation bias. Imagine you researched a company and decided it is a great investment. You bought the stock. Now your brain starts doing something sneaky. It begins filtering reality. Good news about the company? You notice it immediately. Bad news? You scroll right past it or find a reason to dismiss it. Your mind is not looking for truth anymore. It is looking for evidence that you were right. Researchers call this motivated reasoning. And it is one of the main reasons investors ignore red flags until it is too late. The fix is uncomfortable but simple. Actively seek out the best argument against your own investment. Make yourself sit with it. If you cannot answer it, that is information. Trap 4 is one of the most seductive. It is called the gambler's fallacy. A stock has gone up 5 days in a row. Your brain whispers, it is due for a correction. Or flip it around. A stock has dropped for 3 weeks straight. Your brain says, it has to bounce soon. Neither of those thoughts are logical. Markets do not have memory. Each day is its own event. But our pattern-seeking brains desperately want to find order in chaos. This fallacy pushes investors to make timing decisions based on streaks instead of fundamentals. And timing the market? Study after study shows that even professional traders cannot do it consistently. The market does not owe you a reversal, ever. Now we get into trap 5. Overconfidence bias. After a few wins, something shifts. The investor who once read every disclaimer now feels like they have cracked the code. They start taking bigger positions. They stop doing as much research. They confuse a bull market with personal brilliance. A study from UC Davis found that overconfident investors traded 45% more than average, and their returns were significantly lower because of it. More trading means more fees, more taxes, more chances to make emotional decisions. The market has a humbling way of reminding overconfident investors who is actually in charge. Success in investing is partly skill, sure. But in the short term, luck plays a much bigger role than most people are willing to admit. Trap 6 is anchoring, and it is everywhere once you see it. An investor buys a stock at $80. It drops to $50. Now, every time they look at it, their brain frames $50 through the lens of $80. They think of it as a $30 discount, not as a stock that is just worth $50 today. That anchor, that original price, has no bearing on where the stock is going, but it shapes every decision they make about it. You see anchoring in real estate, in salary negotiations, in everyday shopping. Your brain latches onto the first number it hears and uses it as a reference point forever. In investing, this can trap you in bad positions for years while you wait for a price that the market may never visit again. Trap 7 is information overload, and Trap 8 is recency bias. I'm putting these together because they feed each other. We live in an era where financial news is 24 hours a day, social media is full of hot takes, and your brokerage app sends you alerts every few minutes. More information sounds like a good thing. But research shows that beyond a certain point, more data leads to worse decisions. Your brain gets overwhelmed and defaults to whatever happened most recently. That is recency bias. The market crashed last month? Surely it will crash again. The market boomed this quarter? Surely it keeps going up. The investor who checks their portfolio every hour makes far more emotional decisions than the one who checks it once a month. Sometimes the best investment move is logging off. So here is the mindset shift that ties all of this together. The goal is not to eliminate your emotions. That is impossible. The goal is to build a system that makes it harder for your emotions to make decisions for you. Write down your investment thesis before you buy anything. Set rules for when you will sell before you are emotional. Check your portfolio less often. Diversify so that no single position has the power to panic you. The investors who build real wealth over time are not the smartest people in the room. They are the most consistent. They are the ones who recognize their own